It feels like just yesterday that the digital asset space was buzzing with excitement as Bitcoin triumphantly soared past the $120,000 mark. Today, on August 4th, 2025, the mood has shifted dramatically. The vibrant green candles that once dominated trading charts have been replaced by a sea of red, signaling a sharp and sudden downturn that has left many investors unsettled. This isn't just a minor dip. It's a significant market event that has seen Bitcoin tumble from its recent peak near $122,000 to a worrying low of around $112,000. This steep decline has had a ripple effect across the entire ecosystem, sending shockwaves through every major digital asset. The fallout from this price drop has been both swift and severe. In a single 24-hour period, the market witnessed a staggering $372 million in liquidations, a painful process where exchanges forcibly close leverage positions to prevent further losses. This impacted over 115,000 traders, with those betting on rising prices, the longs, bearing the brunt of the pain, losing approximately $322 million. Ethereum, the second largest cryptocurrency, was not spared from the carnage. It fell from a strong position above $3,500 to just under $3,400, leading the liquidation charts with $119 million in forced sales, even surpassing Bitcoin in this unfortunate metric. This kind of volatility, while alarming, is not entirely new to seasoned crypto veterans. The history of digital assets is punctuated by breathtaking rallies followed by equally dramatic corrections. Many will recall the crashes of previous cycles, where prices fell by 80% or more, only to eventually recover and reach new all-time highs. Each of these past downturns was fueled by its own unique mix of fear, uncertainty, and doubt. The current situation is no different, driven by a powerful combination of global economic pressures and growing regulatory scrutiny that is testing the resilience of the market and the conviction of its participants. The core question on everyone's mind is simple. Why is this happening now? The answer is complex, involving a web of interconnected factors that extend far beyond the crypto space itself. Global economic policies, new government rules, and even predictable seasonal patterns are all playing a role in this unfolding drama. Understanding these forces is the first step toward making sense of the chaos and figuring out what might come next for Bitcoin and the broader world of digital finance. It's a critical moment of truth for the industry, forcing everyone to look past the hype and focus on the fundamentals. A primary driver of this market-wide downturn is the challenging macroeconomic environment, particularly the policies coming from the United States. The Federal Reserve has decided to hold interest rates steady at a relatively high 4.25% to 4.5%, giving no indication of cutting them anytime soon. High interest rates make traditional, safer investments like government bonds more attractive, pulling money away from riskier assets like cryptocurrencies and tech stocks. When investors can get a decent, low-risk return, they are less inclined to gamble on the volatile crypto markets. This risk-off sentiment has been further strengthened by recent strong U.S. jobs data, which suggests the economy is robust enough to handle these higher rates for longer. Adding to the economic pressure is a growing cloud of regulatory uncertainty. Governments around the world are no longer taking a hands-off approach to digital assets. In the United States, a new White House report on the crypto industry, coupled with proposed legislation like the Genius Act, aimed at curbing illicit crypto use, has sent a chill through the market. Investors dislike uncertainty more than anything, and the prospect of strict new rules creates fear that future growth could be stifled. This regulatory pressure is not just a domestic issue. Global bodies are also signaling tighter controls, creating a coordinated headwind for the industry. Furthermore, the flow of new money into the market has started to slow down, indicating that buying interest is fading. Just a month ago, capital inflows into Bitcoin were over $62 billion, but that figure has now dropped to around $59 billion. This decline is also visible in the performance of spot Bitcoin ETFs, which recently experienced one of their largest ever single-day outflows, with over $800 million being pulled out by investors. When big institutional players start selling, it sends a powerful bearish signal to the rest of the market, often triggering a cascade of selling from smaller retail investors who follow their lead. Finally, we cannot ignore the technical and seasonal factors at play. From a charting perspective, Bitcoin failed to break through a key resistance level near the $122,000 mark, a point where many traders had set sell orders to take profits. Once this ceiling proved too strong, a wave of selling began. This was compounded by historical trends, as August has traditionally been a weak month for Bitcoin, often seeing price declines of 5 to 20% over the past decade. This combination of technical rejection and seasonal weakness created a perfect storm for the current price correction we are witnessing today. With prices falling so quickly, many are asking if the crypto bull market is officially over. To answer this, it's important to understand the difference between the two market states. A bull market is characterized by a sustained period of rising prices, widespread optimism, and strong investor confidence. It's a time when good news seems to propel assets to new highs, and every dip is seen as a buying opportunity. In contrast, a bear market is a period of prolonged price declines, where pessimism reigns supreme and investor sentiment is overwhelmingly negative. In a bear market, rallies are often short-lived and seen as opportunities to sell before the next leg down. Based on the current conditions, it's clear that we have entered a significant bearish correction phase within a larger market cycle. The high volatility, large-scale liquidations, and the failure to sustain new highs are all classic hallmarks of a bear market environment. While Bitcoin did achieve a remarkable peak above $120,000 this year, the subsequent price action is consistent with the post-halving corrections seen in previous four-year cycles. Historically, after a major rally driven by the Bitcoin halving event, the market often experiences a deep and prolonged pullback, as early investors take profits and macroeconomic realities set in. This downturn has been particularly painful because of the high amount of leverage in the system. When traders use borrowed money to amplify their bets, it creates a fragile market structure. As prices began to fall, these leveraged long positions were automatically liquidated, which in turn created more selling pressure, pushing prices down even further. This cascading effect is a signature feature of crypto bear markets, where the decline feeds on itself, washing out speculators and resetting market expectations. The current environment is a stark reminder that what goes up can, and often does, come down with incredible speed. However, it's crucial to distinguish between a temporary bear market correction and a complete collapse of the asset class. While the short-term outlook is undoubtedly bearish, many long-term believers see these periods as necessary for the market's health. Bear markets shake out weak hands, eliminate excessive speculation, and force the industry to focus on building real-world utility rather than just chasing price gains. The question is not whether this is a bear market, it certainly feels like one, but rather how long it will last and how low prices will go before a new foundation for growth can be established. Looking ahead, expert opinions on the market's next move are divided, though the short-term sentiment leans heavily bearish. Prominent analysts like Arthur Hayes, the co-founder of BitMEX, have pointed to ongoing macro pressures and a new U.S. tariff law expected later this year as reasons for further decline. His forecast suggests that Bitcoin could drop to the psychologically important $100,000 level, while Ethereum might fall to $3,000. Technical analysts are closely watching support levels between $110,000 and $112,000 for Bitcoin. If the price breaks below this zone, the next stop could be as low as $106,000, extending the market's pain. Despite the gloomy short-term outlook, the dream of Bitcoin reaching astronomical figures like $500,000 or even $1 million remains a topic of discussion, though it is not supported by current analysis. These price targets are typically part of long-term bull case scenarios that depend on factors like mass global adoption, Bitcoin becoming a primary reserve asset, and a significant devaluation of fiat currencies. Right now, with central banks holding firm on interest rates and regulatory pressure mounting, these ultra-bullish predictions feel more distant than ever. The immediate focus for most experts is on risk management and navigating the current downturn, not on forecasting new all-time highs. For those wondering if this is the right time to buy, caution is the word of the day. While some, like Eric Trump, have framed the dip as a buying opportunity, it is a high-risk strategy. The idea of buying the dip is appealing, but it's incredibly difficult to know if you're buying at a temporary low or just at the beginning of a much deeper crash. Some analysts suggest that alternative cryptocurrencies like XRP could see short-term outperformance, especially with rumors of a potential spot ETF. but also warn that such a rally could be a trap followed by a massive correction. There is no consensus on a single best crypto to buy right now. For beginners venturing into this volatile landscape, the best advice is to proceed with extreme caution. First, never invest more than you are willing to lose. The crypto market is notoriously unpredictable and your capital is at risk. Second, do your own research. Dior. Don't rely on social media hype or celebrity endorsements. Instead, read project white papers, understand the technology, and learn about the economic factors influencing the market. Finally, consider dollar cost averaging (DCA), investing a fixed amount of money at regular intervals to reduce the risk of buying at a market top. This storm will eventually pass, but navigating it safely requires patience, education, and a clear-headed strategy.